Welcome back to The Explainer. Today we're tearing down everything you thought you knew about Wall Street. I mean, forget the ticker tapes and all that frantic shouting. We're going to look at the actual under-the-hood mechanics of the stock market. We're talking myths, mechanics, and the truly fascinating reality underneath the whole shebang. Okay, let's dive into this.
Let's start right off the bat with a question that trips up, well, almost everyone. Really think about it for a second. Where does your money actually go when you buy a stock? You open up your brokerage app, you tap buy on a share of Apple, and boom, $200 leaves your account. Most folks just kind of assume that money goes straight to Apple headquarters over in Cupertino, maybe to help build the next iPhone, right? But it doesn't. Not even a single cent. Honestly, Apple doesn't even know you exist.
It's what I like to call the donation box myth versus the actual reality. See, the stock market is absolutely not a donation box for giant corporations. When you buy that share of Apple, the reality is you are paying a total stranger. Literally. Someone you will never ever meet who just woke up today and simply decided, hey, it's a good day to sell my Apple stock. Your money goes to them and their share goes to you. The company itself is completely uninvolved, standing on the sidelines. Yet somehow, this crazy invisible handshake between complete strangers moves billions of dollars and shifts global retirement funds every single day. Wild, right?
All right, moving on to Section 1, Splitting the Risk.
To understand how we even got to this incredible system of strangers trading digital shares in mere milliseconds, we actually have to look back at the historical problem the stock market was built to solve. Because it didn't start with computer algorithms, it started with a very real, very dangerous physical problem. The year is 1602. That's the year the Dutch East India Company was founded. And this date is totally critical because this entity is widely considered the very first company to ever issue shares to the public. So everything you're swiping through on your modern trading app today, it is simply this exact same 17th century idea, just scaled way up and made instantaneous.
But why 1602? Well, just picture the immense risks of the 17th century spice trade. Imagine you're a wealthy Amsterdam merchant. There's an absolute fortune to be made bringing spices back from Asia, but you are facing pirates, catastrophic storms, and disease. I mean, the cost to fund a single voyage is just enormous. If that ship sinks, you lose absolutely everything. It's utter financial ruin for a single merchant. So a genuinely brilliant financial innovation was born, splitting the risk. It's so simple, but so genius. Instead of one person carrying the whole burden, dozens of people chip in a smaller amount. If the ship returns totally loaded with spices, everybody shares the profit based on what they originally put in. But if it sinks to the bottom of the ocean, no single person goes bankrupt. You share the loss.
Which brings us to Section 2, what ownership actually means.
Now let's fast forward to today, because if you buy a share today, you are fundamentally buying a piece of ownership. But let's be super precise about what that entails. You don't own a literal physical desk at Apple. You can't just stroll into an Amazon warehouse and start bossing people around, telling them which boxes to move. It's much more abstract than that. And honestly, in many ways, it's much more powerful than physical property. And this brilliantly illustrates the concept. It's what we call the unbaked pizza analogy. Think of your share as a slice of a pizza that hasn't even been put in the oven yet. You don't know exactly how big or how delicious it's going to turn out. But if the company earns more money and expands into new markets, the entire pizza grows. And as the whole pie gets bigger, your specific slice grows right along with it. But, on the flip side, if the company falters, if the pizza burns, your slice burns too.
So ultimately, it boils down to this. Ownership means sharing in both the upside and the risk. What you actually own when you hit buy on a stock is a legally binding claim on the future value of that business. It's really a bet on what the company is going to do tomorrow, not just what it owns today.
All right, let's head into Section 3, IPOs and secondary markets.
So if giving away ownership means sharing the upside, you might be wondering, why would a business founder ever want to give away pieces of their company? The answer is super simple. Capital. Cash. Imagine you run a really successful local coffee shop. You've got 5 locations and you want to open 50 more. You need serious money for real estate, fancy espresso machines, staff, the whole 9 yards. Now you could take out a massive bank loan, sure, but you'd be totally crushed by the interest payments, especially if the new stores fail. You could find one single wealthy backer, but then they're constantly looking over your shoulder dictating your every move. Or you could sell shares to the public. And this brings us to the IPO, or initial public offering. By definition, this is the very first major fundraising event where a company sells shares to the public to raise capital. You get money from thousands of investors all at once, so there's no monthly interest and no single micromanager breathing down your neck. And here is the absolutely crucial distinction we hinted at earlier. The IPO, or when a company issues brand new shares, is the one and only moment where your invested money actually goes directly into the company's pockets.
Let's put these two mechanisms side by side to really lock this in. In the primary market, which is the IPO, money flows directly from the investors straight into the company's treasury to fund that massive growth. But once those initial shares are out there circulating in the world, we enter what's called the secondary market. And this is what you and I participate in every single day. In the secondary market, investors are just trading those existing shares back and forth with each other. The company steps completely aside and basically becomes a mere bystander. So that stock price you're checking on your phone? That isn't how much money the company is receiving. It's literally just a real-time measure of what investors believe the company is worth at that exact second in time.
Let's move to and see how this builds in Section 4, the market players and exchanges.
Now that we know we are just trading with other investors in this massive secondary market, we need to understand exactly where these trades are happening and, honestly, more importantly, who you are actually trading against. The where is the stock exchange. Now, while you might immediately picture that iconic physical building of the New York Stock Exchange with all the shouting, today exchanges like the NYSE and NASDAQ are essentially just highly regulated, ultra-fast matchmaking systems. They're giant servers. When you hit buy on your phone, you aren't personally wandering around the streets trying to find a seller. No way. Your broker shoots your order right into the exchange's sophisticated software. It instantly scours the network, finds someone willing to sell at your exact price, matches you up, logs it, and updates the global price. And it does all of this in a fraction of a millisecond.
But who is actually on the other end of that millisecond match? Well, there are four main players in this ecosystem. First up, retail investors. That's usually us, regular people investing through apps with a long-term horizon, holding shares for years to build a nest egg. Then you have traders. These folks are chasing short-term price swings. It's high stress, it's high risk, and statistically speaking, most of them lose money. The real gravity in the market, however, comes from institutional investors. Think massive hedge funds, pension funds, and mutual funds managing literally trillions of dollars. They have insane algorithms and huge research teams. When they decide to buy or sell, their sheer size physically moves the market price. And finally, we have the unsung heroes, market makers. These are players who sit on both sides of the trade simultaneously. They are always willing to buy and always willing to sell, and they profit off the tiny little spread in prices. Without market makers providing this constant, reliable liquidity, finding a match for your trade would be incredibly difficult and frustrating.
Which leads us perfectly into Section 5, supply, demand, and expectations.
Okay, so we know the players and we know the arena. But how does that matchmaking software actually calculate the exact, down-to-the-penny price of a stock at any given second? Well, it all comes down to two surprisingly simple numbers, the bid and the ask. The bid is the absolute highest price a buyer is currently willing to pay. The ask is the lowest price a seller is currently willing to accept. When those two numbers eventually meet in the middle, boom, a trade executes. And that exact meeting point, that instantly becomes the official latest price of the stock.
It is pure, unfiltered supply and demand, and it's driven entirely by human behavior. Let's say there is some really great news, and suddenly there are far more buyers than sellers. Well, those buyers have to start competing with each other, right? They offer higher and higher bids just to convince someone to let go of their shares, which drives the price up. The exact opposite happens if panic sets in. If there are more sellers than buyers, those sellers have to constantly undercut each other's ask price just to attract a buyer, and that drives the stock price down.
So, the crucial point is this. The market is constantly pricing in expectations, not just reality. Actually, let me repeat that because it's a real game changer. The market prices in expectations, not just reality. This right here is the secret to understanding why the market often feels so completely disconnected from the real world. A company could post record-breaking profits today, but if investors expected even higher profits, the stock price will actually drop. It sounds crazy, but it's true. Conversely, a tech startup might have absolutely zero revenue, yet command $1 billion valuation simply because enough people believe in its future potential. The stock market is essentially a giant, real-time voting machine on what millions of people think tomorrow will look like.
Which leaves us with this final, somewhat provocative thought. The next time you look at a stock chart and you see that little line squiggling up and down in real time, remember what you are actually looking at. It's not a direct reflection of a company's bank account. It's a complex, millisecond by millisecond negotiation between strangers, algorithms, and giant institutions. So as you go out there and build your own portfolio, you really have to